Thanks everyone for coming along this morning, attending this session. We're delighted to take you through our half one results for FY22. Amazing numbers as you'll hear when we come and talk through the numbers in a second. For those of you that don't know us, just a quick intro. So I'm Neal Gandhi. I'm the CEO, co-founder of the group, and I'm joined by Ollie Rigby, CFO and co-founder as well. So I guess how we're going to run today, a quick summary from me without going into too many of the numbers, without stealing Ollie's thunder, and then financial and ESG results from Ollie, and then I'll come back with an operational review, strategy, outlook, and then we'll open up for Q&A. So a quick half year summary, in terms of growth, excellent financial growth, 77% revenue growth, of which 21% like-for-like growth, 118% cash conversion ratio. So, the business continues to grow incredibly well. We have growth in our key markets, including growth in healthcare. We won NHS Blood and Transplant, NHS Business Services Authority, continue to work with NHS Digital, continue to work with NHSX. Both of those obviously rolling into NHS England going forwards. We appointed Noel Gordon as a healthcare advisor. Noel was non-exec director on NHS England until 2020 and previously chaired NHS Digital as well. So really building out our capabilities in healthcare and our brand in healthcare. One thing we're really pleased with is institutional holders has gone from 8% in September 20 to 21% today. So real growth in institutional holders and continued momentum there. So we're really happy with that. In terms of expansion, acquisitions, we acquired Nudge Digital. That put us into the pharmaceutical sector. Today, we count 4 or 5 major pharmaceutical companies as clients. Obviously, that puts us onto their approved supplier list. And getting on those approved supplier lists is very difficult. So it gives us an opportunity now to really expand out our offer through that acquisition. We've talked about building out our team. And then the big news, I guess, for the half has been the move to a single new brand, TPXimpact, and the beginnings of the implementation of the unitary structure. I'll come and explain some of that in a bit more detail later on. And investment for growth. And again, I'll explain Open Dialogue, which is a new product, a new SaaS product that we launched in August, and what's happening with that as we look to send that off on its journey and into its own trajectory. So look, that's a quick intro from me. I'll hand straight over to Ollie.
Morning. Thank you, Neal. Thanks everyone for taking the time this morning to hear us run through the results. As Neal said, fantastic set of half-year results. Absolutely delighted with them. Revenue up 77% to 37.5 million. But as Neal alluded to, most pleasingly, we continue the like-for-like organic growth that we saw in prior year with 21% organic growth in the first half of the year. That has translated into strong EBITDA growth, up 83% to 5.3 million against prior year 2.9 million. Probably most pleasingly, though, is that we've seen a 40 basis point improvement in EBITDA margin from 13.7% to 14.1%, despite the fact that prior year period was obviously peak COVID, where there was no spend on travel, entertainment, etc., which we started to see come back, obviously, in the half reported here. We've got another slide looking at sort of growth in margin over the last 3 years, and also with some views about how that's going to change going forward in a couple of slides' time, which Neal will run through. That translated into our first statutory profit. I'll again run through this in a lot more detail in a minute, but we don't believe a statutory profit number is the right way to view the performance of our business. We continue to believe an adjusted profit number is the right way to view the performance of the business. It basically translates to our cash flow, and I'll talk you through that in a few slides' time. In terms of EPS, that translated again into very strong growth, 81% up to 4.7p versus 2.6p. Again, further detail on that to follow. And all that performance generated significant cash. So cash conversion was at 118% for the half. Our cash improved by 2.6 million, despite the fact that we paid 1.8 million out for acquisitions during the period. In terms of sort of contract wins in the period, again, record performance for 54 million of contracts signed in the half, up from 25 million in the prior year. And that leaves us with a sales backlog number, so orders to be fulfilled in the second half of 34.6 million. Again, significantly up on prior year. So if you take the 34.6 million and add it to the first half, 37.5 million, we get to, circa 72 million for the year against analyst consensus of 77. So very little additional work to be won in the period to deliver and hit that number, giving us good confidence over full year outlook. worth also noting that we have announced an interim dividend of 0.3p, which is up 50% on prior year as well. Moving on, as most of you will know that have joined these calls before, if you haven't before, we're a very purpose-led organisation and we balance and think about profit and purpose in equal measure. So delighted to report our ESG results as well for the period. Now, I'll just touch on these before coming back to some more financials in a second. Our workforce continues to grow at pace. We hired 103 people in the period. And what we're delighted about is that we continue to see a happy workforce that continues to be confident in leaders, despite the fact that we are going through significant change at TPXimpact. So we announced the move to one brand back here at the end of the summer, working with our teams through that transition period over the last 3 months and into the new year. So it's great to see that our team are on board with that. In terms of diversity, we're very keen to create a diverse organisation, as diverse an organisation as possible. We believe that will deliver the best return as well as being in line with our values. And we've got now 51% of women in our business. I think most pleasingly in terms of statistics around that, we have, of the 13 businesses that we've acquired, it's interesting to note that 26 out of the 28 board members on those businesses were male at acquisition, and 2 female. And we now have a leadership group, senior leadership group within our organisation that is pretty much exactly 50-50 male, female split. We continue to invest in communities and donated 702 hours to communities in the first half, as well as continuing to run our Future Leaders programme that supports entrepreneurs from disadvantaged backgrounds or social entrepreneurs, which is, I have to say, a flagship for us and really exciting. We've got a cohort finishing tomorrow. Back looking at some of the financials, this just shows a little bit of the performance of the group since we came together. For many of you won't know that, effectively we came together on the 4th of December 2018 and have grown significantly from what was a pre-IPO number of about 15 million revenue up to consensus this year of 77 million, and that continues to drive EBITDA growth as well. This next slide just talks you through cash flow, and again, just want to highlight why I see an adjusted number profit is the right way to view the performance of the business. You can see here that adjusted EBITDA was 5.3 million, which translated into net cash from operations of 5.1, despite the exceptional costs that occurred in the half relating to acquisitions. The only other point I'd make in here really is that net cash from acquisitions looks like a positive, like that we paid 0.7 million, and that the final number there on the right hand side shows 4.7 million cash increase in the period. For those that were concentrating at the start, I did say it was only 2.6 million. From a statutory perspective, our cash increased by 4.7 million, but there was 2.1 million of cash that was payable out for acquisitions post period end. So we basically removed it from our cash position at the year end when we've been reporting it. In terms of revenue breakdown, if anyone's seen this historically, you'll note that the only major shift here is around recurring revenue, where we've seen a significant increase from 20% to 33%, largely as a result of the acquisition of Kits back in March of 2021, which is a predominantly managed service business. So you can see that has pushed up our recurring revenue, which obviously gives us better visibility at the start of every year. We continue to have a significant amount of repeat business of customers continuing to work with us, where we've worked with them historically and continue to do a good job for them. Just going to spend a bit more time. So this is the statutory P&L. You can see the first statutory profit at £278,000. I'm going to make this point 3 or 4 times today because we've just seen a few comments around this and just want to make it super clear why that number is interesting, but we prefer to focus on the number on the next slide. So if you take the 278 and add back the tax charge there, that would take you to our statutory profit before tax of 559 at the top of that slide. In terms of the difference between the statutory profit and our adjusted profit before tax number there of 4.5 million, there are a number of numbers in here which I'm just going to spend a bit of time on. So you can see an amortization charge in the period of 2.5 million. And this is pretty boring accountancy stuff, but I'll just quickly explain it. So the reason this occurs, and it didn't used to occur, is a change in the accounting treatment for acquisitions. If we acquire a business for, I'm going to call it £11 million with £1 million worth of net assets, historically, you would recognise £10 million as goodwill. And that goodwill would go onto the balance sheet and it would be assessed every year for impairment against the profitability of that business. And assuming the business continued to perform well, that asset would continue to sit there ad infinitum and be reviewed each year for impairment. The rules changed like 3 or 4 or 5 years ago to mean that you could no longer put all of that goodwill into goodwill, and you had to recognize some in intangible assets. And typically you would see about 30% of that number now recorded in intangible assets. So in the same scenario, if 10 million of effective goodwill in the old days would mean 7 million goes into goodwill and 3 million goes into intangible assets. You then have to write off that 3 million of intangible assets, notwithstanding the performance of the business over 4 years or so, which is basically what that charge is there. So that's what the amortization charge is. The loss on fair value movement of contingent consideration, we've talked about this historically, and we said it would come down, and it will come down. This is a legacy of the earnouts, the structures that we historically had in place, which meant that we would pay additional consideration for businesses based on performance. And again, just to go into a bit of detail, if we were buying that business, a business for 11 million, and there was an earnout where we might have to pay another, say, £2 million, we have to make an assessment at the point we bought it about how much further consideration we would pay out. If we assumed it was 12 million we would pay out, and actually they delivered 13 million we had to pay out, so that extra £1 million we have to pay out goes through the P&L as a charge, just based on us underestimating that number. It could be that a business underperforms, you end up actually with a clawback situation, and we would then end up with a credit through our P&L, which would make our stat profit look incredibly positive, despite the fact that perhaps our overall performance wasn't very strong. So that's again why for us it's not a number that should be included at all in here. But as I say, that will start to disappear from our numbers going forward, because we're no longer looking at deals with earnouts in place. And the last deal with an earnout completes at the end of this financial year. So we anticipate seeing that number really fall away over the next 12 months. The share-based payments in there that we add back in line with our peers, and also then you've got some costs relating to acquisitions, as well as some investment we've made into a SaaS AI product that Neal's going to talk you through a little bit in a second, and that takes you through to the adjusted profit number. And again, that's broadly the number that translates then into cash. In terms of then how this then flows through to EPS, we use that profit after tax number from the prior slide, adjusted number. We then look at this on a very prudent basis. We take the weighted average basic shares in issue during the period. We add in the maximum shares to be issued subject to share options. And then we look at the maximum contingent consideration that we could pay out based on maximum dilution. So a lot of the historic deals we've signed where these shares are still to be issued, those shares could be issued at the higher of 74p and the current share price. At 74p, obviously that would result in significantly more dilution. So in this case, about 7.2 million shares. The reality is that based on the share price on the 30th of November, that number of shares drops to 2.15 million shares, which would have improved EPS. Well, if you use that number, it would improve EPS to 4.9p. Last slide from me. Here is the balance sheet. Again, you can see that goodwill and intangible assets point that I was talking to you about earlier. Cash, you can see 10.4 million. We've reported adjusted cash minus that 2.1 million that's payable out for acquisitions. In terms of borrowings, continue to be well supported by HSBC, but our net debt position at 4.7 million is below, so about 0.4 times net debt to EBITDA ratio, and the facility is up to 2 times. So considerable headroom for us to expand and make further acquisitions with debt without putting too much pressure on the balance sheet. I would note that the contingent consideration here is 2.1 of that is the cash that we saw on the cash side that I've taken out, and the remainder is the shares that we saw in the EPS calculation, so non-cash, and equally the deferred tax is non-cash as well. So once you strip out the contingent consideration and deferred tax, we've got a current ratio of 1.9 times, up from 1.7 at the end of last year. So strengthening balance sheet in the period. And that is it from me. Back to you, Neal.
Cool, thank you very much. So quick operational review of the half, things that I haven't talked about yet. So for example, the organic growth, you see that we won 5 £3 million plus contracts in the half versus 4 £3 million plus contracts in the entire financial year. Great news there. And that plays out against probably 3 £3 million plus contracts won by all the companies in their collective histories that probably runs to multiple decades. So you can see that trajectory. We're becoming very used to winning larger contracts. It's become, whereas possibly for some of our people it would have phased them before. Today, as I look at our pipeline, we have multiple significant contracts on there. It's become the normal thing to do. I'd love to get it to one a month, and but that's kind of the trajectory that we're heading towards over the next year or so. We talked about the acquisition of Nudge already and expanding into pharmaceuticals. Actually, I haven't touched on utilities. So you'll have seen that we announced back in September that we want a contract with the utilities company worth up to £10 million over 5 years. A number of things interesting there. First, the utilities. Next thing's a 5-year contract. The next thing is actually we leveraged capabilities that we brought in through the acquisition of kits and the referenceability that we had there to win that contract. If we hadn't had that referenceability, I don't think we would have won that £10 million contract. So, really leveraging what we've bought into other parts of the group and growing out revenues accordingly. We have a continued strong M&A pipeline. Expect us to see, historically, we've done 3 or 4 deals for every financial year. And I guess you'd expect us to continue to do that. We've done 1 in the half, and so expect us to do more M&A. Really good pipeline. There are some specific gaps in our portfolio that we're looking to cover off today. On the ESG side, we achieved Social Value Quality Mark Level 1. This is a new accreditation. Cabinet Office have already been accredited to it. Only about 50 organisations across a multitude of sectors that have achieved this so far, and it's really a sign of where we want to go to. I'll come and talk about B Corporation in a bit as well. We launched our employee resource group. So, diversity and inclusion is a big deal for us. And the way that we make that happen is that we provide forums for people in our case, for women, LGBTQI and minority ethnic groups. We provide those forums for our employees, create safe spaces. And as a consequence, it means that we're able to find more people from diverse backgrounds to come join the organization. And we truly believe that a diverse organization makes the best decisions. And there are so many examples operationally where I see that every day. We launched our board mentoring program. So one of the things we recognize, and you'll see in the stats that Ollie presented, is we lack ethnic minority representation at the most senior levels of the company. And that's a societal thing. So what we've done is we've offered up, our PLC board members have offered up their time to mentor individuals from within our organization, and that's a program that's up and running, and I think the people who are participating are really enjoying that. On the innovation side, Ollie mentioned open dialogue. I think I mentioned it earlier as well. So what that is so we bought Greenshoot Labs in early 2019. We always knew there was something in there. That was bought as a services company around conversational AI. We always knew there was something in there though. So we put some money into R&D against this and launched a SaaS product, conversational AI SaaS product, in August. And we've been kind of blown away by what's happened there. So it's been marketed to conversational designers. They're very specific job titles, so very easy to market to online. And we found that there are some globally significant organizations that have picked up on it. And in fact, 1 or 2, one in particular that I know of, has called it a game changer in conversational AI. So the ability to genuinely speak to and have a conversation with Alexa. And so what we've decided to do, because that needs to go off on its own trajectory now, it needs to have its own funding. We are a cash generative, growing, profitable services company. This is not the right home for a potential unicorn that we believe this could well be with the right execution, the right team and the right plan, the right money. So that will be spun out. We will retain a minority ownership position in that. And then it can go off on its own journey, and it means that we can, divert our own cash towards growing the core business that we are today. And then the big move is the move to the single integrated brand in the UK, and as part of that, we've appointed the new leadership team, as Ollie touched on earlier. So it's been a busy half, as you might expect us to have, and I guess we've become known as having those kind of quite intense periods and for them to continue. So, long may it continue, and I'll talk about outlook in a bit, but long may it continue into the second half and beyond. In terms of our market, some of you will have seen this already. This is the macro picture. So this is taken from Tech Market Views Public Sector Software and IT Services report for 2021. And what it shows you is new versus heritage. So new means move to cloud, agile working practices, design-led work, and data as well. And you see that that's the place that we play in. Our larger systems integrator type companies have always played in that kind of heritage space and are trying to move into this new space. Sometimes we believe that their organizational structure, their way of working, makes it very difficult for them to be competitive in this space. Obviously, they continue to win there, but whether the client's getting great outcomes is a different matter. So this is the new space that we're working in. As you can see, by 2024, expected to be 57% of the market. That's the world that we operate in. Significant growth, great opportunity in front of us as a consequence of that. We recently took another view on the market and had some further data produced for us, which is taking Global Data's report, adding it to Tech Market Views, and kind of creating a blended view. Because what we wanted to understand is how much of that, what is broadly lumped into IT services, how much of that is technology, how much of that is data, how much of that is design. As you see here, technology is the lion's share at 46%. What's startling and interesting is data, though, right? So you see 33% there in analytics, machine learning, and significant opportunities there. And that's an area that we don't have an offer in today, really. We kind of do, but it's not as strong as it could be. So I think from an M&A perspective, you'll expect to see us look to fill that gap. What's also interesting is 20% in design. Design is not designing like front-end development or whatever. It's not what design is. Design is looking at a service as it works today and redesigning how it works. So a program of work that we're doing right now for LandReg is looking to redesign how the house buying process works in the UK. It's archaic, it's slow, it's frustrating. And so they've asked us on a very short engagement, actually, as part of a bigger program that we're doing for them, to really look at how does that work? How can we improve it? How can digital transformation really help us to change the way that can actually work? Really exciting work that we're doing there. And I would say that we probably have the largest public sector focused service design team in the UK. And while we've been disparate, we've not been able to make that claim. While we bring everything together, we can make that claim. And I think that's something that you'll see us market into the future. So very exciting there. In terms of strategy, so, what I'll cover off is the big thing is coming together. And, why are we doing that? So in all honesty, what has been happening up until recently is we had our family of brands approach with an underlying kind of collaboration layer was great, and it had worked. Clearly, it had worked. But we could see areas of friction that were emerging and becoming bigger and bigger, and it's something that we needed to deal with. So, firstly, typically on a public sector bid, you get the date of publication of the request for proposal through to first submission. You usually get 10 days. We were spending the first day, so 10% of our time, working out which brand to front it with. Clearly, that's a waste of time. That's not something we're looking for. Also, when we won stuff, we would then have a scramble for who's going to staff it. Have you got any people over there? And then this internal conversation between internal P&L owners around whether they were going to release their stuff. So, one P&L owner that might have had availability might be saying, well, I'm not sure because I've got this other deal that I'm working on and maybe that will land. And so I'm not sure I want to release my people, which is part of how you end up with more contractors than you need or more associates than you typically need. So breaking down those silos is, one of the big wins. As is sector sales specialists, we'd got to the point where we had multiple companies, each with capability to sell into local government. And so bringing it all together, having a single group for central government, a single group for health, a single group for local government, etc., gives us some real leverageability there. In terms of marketing, if you look at the combined marketing organization and cost of all of our companies doing their own marketing, put it all together, you end up with substantially greater opportunities to market a brand new brand as an integrated offer, an end-to-end integrated offer, so that our customers really understand the capability and breadth of what we can do. So huge opportunities there about being more effective. Efficiencies, we're putting in a new finance system at the moment, NetSuite. We're putting in a new HR system at the moment. We're putting in a new recruitment management system at the moment. And then after that will come CRM and professional service automation. These, it will take time. Once they're in, we're convinced that we end up with a substantially more efficient organization as a consequence. Shared services, marketing and sales I've talked about, but HR and finance. HR have already come together to a single integrated HR team. And last half alone, we hired 103 people. So it just shows you the effect that you can do of bringing the capabilities together and leveraging all of our capabilities. And there's more to come there. In terms of better utilization, one of the things we're doing in the reorg and bringing everything together is creating a function we call kind of air traffic control, which is looking out at what's coming down the pipe from a forecasting perspective, and then looking at what our projects we're on and where our people are, and then working through how to maximize that kind of utilization. I think that is where we'll end up with some further margin opportunities as well. In terms of attracting the right talent, bringing it all together means that we can really differentiate ourselves as an employer and really create a modern 2021 and plus employee value proposition, recognizing the need for hybrid working, recognizing the need for people to live wherever they want to live and embracing that fully as an employer. More diverse leadership team, the sort of 50-50 male-female split in our leadership team means that we can attract even more talent towards us as a consequence of that. And you'll see us launch an academy, and I will talk about an academy in a little while. And then finally, in terms of maximizing impact, there's enhanced investment in communities, but B Corp, let me focus on B Corp in the interest of time. So B Corp is a global certification program really designed to certify companies that are truly run in the interest of multiple stakeholders, all stakeholders, rather than just exclusively in the name of profit. Those of you that have heard me speak before will know that I firmly believe that companies run in this way end up delivering better shareholder value because they're just better run companies. The reality is that we would get B Corp status today if we're a single UK P&L. At the moment, it would be too hard because of the multiple legal entities that we have. As we bring it all together, we will then go for B Corp status, and we anticipate getting that at the very latest by March of 2023. And then continuing to focus on that kind of impactful work. The house buying process, how many of us have been frustrated by that in the past? And so driving work like that really motivates our people and really motivates us. It's interesting, it's exciting work. There has been some commentary from others around margin pressure at the moment. And so I just wanted to talk about that and talk about our overall EBITDA levels directly after this. So a few things here. So firstly, I think what has happened for us is that we have been prior to pandemic, we were very London centric. Our biggest offices were in London. And so we were paying London-like wages, and we always have done. And so with the pandemic, we then started recruiting people from all over the place. And in fact, we've just done a map of all of our people, all the postcodes. And the spread that I see on that map is everything, everything from Cornwall to Edinburgh and pretty much everything in between of the people that we've recruited. But what we've never done is we've never stopped to say, hang on, should we be paying, what should we be paying to a developer in South Wales versus a developer in London or whatever? We've just used the same salaries. And I think what we've done is we've exported inflation to others. So if there are companies out there, and I use Admiral Insurance because it's an example that I know, Admiral Insurance in South Wales have historically traded on the fact and taken advantage of the fact that staffing costs are typically a lot lower in South Wales. Now, what we're now doing is going to companies and hiring people out of them, paying the salaries that we've always paid. So yes, we're seeing wage inflation, but we're seeing wage inflation that for us is normal rather than exceptional. And I think that's one thing that I think I'll talk to. In terms of attracting the right talent, we are circa 50% associate to full-time employee. A full-time employee is 15% on average, 15% lower cost compared to a contractor when everything's loaded up. And so just switching that a bit obviously has a margin lever for us. So, that's really interesting for us to start to do. And as we mature up our brand, mature up our employee value proposition, I think we can begin to switch that. Academy, so we will launch our own academy. And so expect to hear more from us on that in due course. I have to say, though, this is all about getting the right balance of being able to put people onto a client project that know what they're doing and delivering on that quality. I think if you put too many sort of graduates from your academy onto a client, I think one of the inevitabilities is that you will lose project quality, and we will not drop our project quality. It's too embedded in who we are. So we will use the academy, whether we'll take in 30-40% of our intake from the academy, I think is a different thing. And then the last thing is leveraging Bulgaria. Now, we've not really been able to leverage our Bulgarian operation as much as we could do because of public sector. So, particularly central government is adverse to using people that are located outside of the UK. However, our commercial clients, the utilities client and another significant client that we recently won in commercial sector, both of those contracts involve us leveraging some of the Bulgarian operations. So we begin to see that grow. And the gross margin opportunity in some of that is 50% plus. So again, it's another lever for us. And so that sort of talks to some of the other commentary that's kind of out in the market. But let me, show you a picture, which is our EBITDA percentage to date. So FY19, 9.5%, FY20, 12.1%, FY21, 13.9%. Quarter that we've just delivered is 14.1%, and the expectation for the year is just over 15%. So we are on a trajectory to increase our EBITDA margin. And over a few years, our goal is to get to high teens, which is where we think we can get to. We can take this to high teens. Our goal is to get to high teens EBITDA margin. And, notwithstanding anything else that's going on in the market, we believe confidently, because of the levers that we've got, that we can continue to get there, and the economies that will kick in as a consequence of bringing everything together. So I'd finally just reiterate the commercial vision. So some of you know this. So we had a commercial vision to March of 23 previously to reach 100 million run rate. We feel like we're about to smash through that. So we thought we better set a new goal before we smash through it, rather than sort of flailing around trying to find the next goal. So we set ourselves a goal of 200 million run rate by March of 25. And one of the drivers for that is just to become a major public sector player, become a top 20. And that would require us on a run rate basis to be about 150. And obviously these numbers are changing all the time, but certainly the goal is to be 200 million run rate by March of 25, continue to deliver on that 10 to 15% like-for-like organic growth, continue to make further earnings enhancing acquisitions. Each of these acquisitions, people talk about dilution. Each of these acquisitions adds to EPS every time. They're always earnings enhancing and they always add to EPS. And I think the magic number for us has always been EPS. It's a case of how much of a percentage of the bigger pie do you own, rather than the actual percentage itself, as far as we're concerned. And then continue to ensure that we generate cash strongly, and as you'll see in the half, 118% cash conversion ratio, and continue to deliver on a dividend. And a lot of people ask us why we do that when we're in growth mode like we are. I think it's just great. We're a services company. We spin off cash. We think it's good discipline for us to do that. So we're very pleased to announce the interim of 0.3 pence. And you can see the half 1/22 progress that we've made against each of those so far as well. Obviously, one thing we always do is have our financial vision that always sits alongside our ESG vision. So we intend to halve the 21 gaps that we've identified across representation, pay, inclusion for employees from underrepresented backgrounds, and continue to work hard at that. We are carbon neutral already. We want to put a stamp on the business that says we are net zero. Now that is difficult to do because it takes years to become certified or verified by SBTi, because you need years of data. So we're hiring a sustainability manager to help us to pull all that data together. But we know already that we are carbon neutral. And then from a community perspective, the big thing this country needs is people to enter digital careers. And so far, we've kickstarted the careers of 1,092 people against a goal of 5,000. Outlook for the rest of the half, I think, as Ollie said, so we have 37.5 million revenue in the first half. We've got 34.6 million booked to be recognised in the second half. So that's 72.1 against analysts' expectation of 77. So we're feeling very confident to deliver in line with those recently upgraded expectations. We will continue to drive at this change program that we're doing to a single brand. Our goal is to end up on the 1st of April with the sales and marketing part of the organization, the organizational change largely done, still lots more work to do, but so that we hit 1st of April, beginning of the new financial year, running, firing on all cylinders, ready to drive the next phase of growth. But from our perspective, the last 3 years, we've been listed 3 years this week. The last 3 years have been the warm-up act, and we intend to take this platform that we've now created to really start to grow from here and head towards that 200 million. So on that note, I think we'll take questions.
We have a question here that says, could you explain why you're moving away from acquisitions structured with deferred considerations or earnouts?
I'll start and maybe Ollie can join, I'll add to it. But the reason being, we're moving towards an integrated organization, and what earnouts do is stop you from being able to integrate companies as quickly as you might want to. Take Nudge Digital as an example. They're great in pharmaceuticals. We want Nudge Digital and the business development people in Nudge Digital to focus on going out, winning pharmaceutical clients and growing those pharmaceutical clients. They don't need to be worrying about all the back office stuff and all the other bits that they typically have to do when they're running their own P&L standalone company, and particularly within the constraint of an earnout. And so it just allows us to integrate companies faster.
Thank you. And there's a question, who's Grant Harris, a 20% holder? Will he divest to institutions in time?
I think Grant is a 12% holder. and he was the founder of Kits, and so he's come in they're on a part cash, part shares deal that we agreed. And yes, he will divest to institutions. I mean, we have great institutional demand. As I said, gone from 8% holding to 21% holding in just over a year, or in about a year, sorry. And we continue to meet institutions and continue to see, we're on many more watch lists than we were on before. So yeah, you would expect to see that come down.
Thank you. How's the staff feedback been to the new leadership structure under TPX?
We measure a monthly pulse of our staff, and I think we scored 7.4 out of 10 the last time around, and that's been pretty consistent now for over a year. So if you look at how we scored a year ago when there wasn't this change, and people were were working within their own individual P&Ls within their own brands, was about the same score as we're getting today. One thing we did do is we pulled all of our UK people together into a single place at the back end of September. It's great to be in a room with hundreds of people. Directly after that, we ran a survey where asking how excited they were about the opportunity of coming together. Where 5 was really exciting and really excited, and 1 was complete disaster. Not complete disaster, but unhappy. And of that survey that we ran, 60% scored 4 and 5, 30% scored 3, which you'd expect, right? People sit on the fence and kind of wait for us to deliver on what we're saying, rather than necessarily kind of just accept it there and then. And then 10% scored 1, and you'd expect that, right? I mean, I think that was a brilliant score. I was super happy with that only 10% would score 1, because those people have joined small companies, individual brands. They had an affinity to that, and for only 10% of people to think that this is going to be a problem for them. We will work with them to do our best to kind of assuage their fears. But at the same time as that, if you joined a company of 20 people, and because you always wanted to work for a company of 20 people, I'm sorry, we are 837. There's not a lot we can kind of do about that. But at the same time as that, there is a pool of people that we think that out in the big systems integrators, they are frustrated by the processes that they work within, that would love to come and work in this company that we're creating. So, we want to bring every single person with us. Absolutely, we want to bring every single person with us, but we fully accept that we can't bring every single individual with us.
Thank you. And how are public sector bodies viewing digital transformation at the moment? Have they moved out of crisis mode?
Very much so. In fact, I think they moved out of crisis mode pretty quickly last year. We started to win projects around, for example, the first NHS blood and transplant deal, I think was it last year? It probably was last year, wasn't it? And that's in no way an emergency COVID related type thing. Most of what we're winning is not. In fact, none of what we've won. I don't think we've won anything that's COVID related since pretty much H1 last year, where we did win a few projects. Ever since then, H2 last year and then H1 just gone, it's that we haven't won any. There hasn't been any COVID related projects for us.
Thank you. And what's your aspiration to have private versus public sector breakdown in revenues by the time you reach your 2025 goal?
We stated 75-25 in the favour of public. Now, whether that is, turns out, I mean, our commercial sector businesses are beginning to grow. That £10 million contract with the utilities company, but others as well that we've recently won that haven't fed through to numbers yet. I think we've got a healthy competitive tension running internally, which is fine, right? Each are trying to outgun each other, and so that helps us to get there. But it's kind of difficult to say. The only number we've put out there right now is 75-25.
And what's the difference between winning a public sector and winning private sector? Is it quicker decision making in one than the other? And what other factors are different between the two?
Yes, it's a contrary to popular belief. Winning in public sector is way faster than winning in commercial sector. And that utilities client took 8 months from decision to signing, or from the process rather, took 8 months, and the signing itself took months and months. Whereas you can win a £5-6 million public sector contract in 2 months flat, because what they do is they publish their timetable alongside the RFP. So you'll respond to phase 1 on this date. There will be a shortlist on this date. There will be you'll then have to submit a detailed proposal and do your presentation by that date, and the contract will be awarded by that date. And the scoring framework is this, and it's all public. And so, I up until this company, I'd never worked public sector before. I have to say it's quite refreshing to find ourselves here where you can have that. Whereas I think commercial sector is much, much harder because it's not subject to such rigorous process, typically as that. So yeah, it's quicker in public sector.
And will you be looking for acquisitions to grow your commercial sector, or is that not a criteria for acquisition?
The main criteria for acquisitions continues to be access to new verticals, as we did with Nudge, but also then new capabilities. So for example, one of the things that we're not strong in right now is the Microsoft stack around. We're strong in Azure, in cloud migration and migrate to Azure, but we're not strong in the kind of Office 365 or Microsoft 365 Power Platform, and that kind of suite of products. Where public sector, both Crown Commercial, Cabinet Office, and NHS have signed big deals with Microsoft, and we're not very big in that space. So I think there are areas that we're looking to add, and data would be another one. The areas that we're looking to add where we can really add to our capability.
Tremendous. Thank you very much. And that's the end of questions. Do you have any closing remarks?
No, just thank you all so much for giving up an hour of your time. We've had a great half year. We're really confident about hitting those expectations for the remainder of the year, and think as I said earlier, I think we're building the platform now for the next stage of growth for the organization, and we're really looking forward to making it happen.